If you're a Merck employee within about 10 years of retirement, there's a decision coming up that you only get to make once, and it can quietly shape the rest of your financial life. Choosing between a lump sum and an annuity pension option isn't just a box you check on a form, it affects how flexible your income is, how much control you have over taxes, how healthcare fits into your retirement timing, and what happens to your money if life doesn't go exactly as planned. In this video, I'm going to show you how to think about this decision using publicly available Merck pension features, realistic planning assumptions, and real-world trade-offs that don't show up on the election form. Here's exactly what we're going to cover: how the lump sum and annuity options work and what each one gives up, why healthcare and retirement timing matter more than most people expect, how taxes and withdrawal strategy change the outcome over time, and how all of this plays out in a realistic hypothetical case study. Before we dive in, my name is Alan Michelle. I'm a financial planner with Michelle Wealth Management. We work with many employees approaching retirement who are trying to make sense of decisions like this, especially when pensions, healthcare, and taxes all intersect at once. And just to be clear, Michelle Wealth Management is not affiliated with or endorsed by Merck. The examples you'll see here are based on publicly available plan structures and anonymized participant scenarios. And this video is for general education, not a recommendation to choose a lump sum or an annuity. The goal is more clarity, not a right answer. So one of the biggest mistakes I see is treating a lump sum versus an annuity purely as a math comparison, which it's not. This decision has implications for your lifestyle and spending flexibility, your tax strategy over multiple decades, how adaptable your plan is to markets and life changes, and what options remain for your surviving spouse or beneficiaries. So with that in mind, let's walk through how these choices actually work. So let's start with someone who is not married. In this case, the lump sum option is approximately $425,000. If you elect the lump sum, the pension is rolled into an individual retirement account or IRA. You control how the money is invested, you control how and when withdrawals happen, and withdrawals are taxed as ordinary income when taken. The biggest advantage here is flexibility. You're not locked into a fixed payment, and your strategy can evolve as tax laws, markets, or spending needs change. One alternative is a single life annuity. That means you receive a monthly payment for the rest of your life. The appeal here is straightforward: guaranteed income, no worries about market volatility, and no investment decisions to manage. The trade-offs would include limited flexibility and no participation in market growth. It's also generally less favorable for your heirs. There are also period certain options, such as a 10-year or 20-year certain annuity. That means that if you pass away before your period ends, your beneficiary continues receiving payments for the remainder of that term. There are also combination options that blend partial lump sum with an annuity, which can be useful for people who want both flexibility and a base level of guaranteed income. So now let's look at a married participant. Instead of period certain options, you'll see joint and survivor percentages, typically 50%, 75%, or 100%. This determines how much of your income continues to your spouse should you pass away first, with the key trade-off being that the higher the survivorship benefit, the lower the monthly payment while both spouses are alive. This is where pension decisions start overlapping with estate planning and tax planning, and not just income planning. So to recap, for an annuity, the pros would include guaranteed income, no market volatility, while the cons would include limited flexibility, no market upside, less favorable for heirs, and inflation risk due to fixed payments. For a lump sum, the pros would include flexibility, market participation, and ability to coordinate tax and estate strategies. While the cons of a lump sum are that it would require disciplined investment and withdrawal plans, it's subject to market and sequence of returns risk, and remember, there is no universally correct answer, only what fits your situation. So now let's dive a little bit into the math of lump sum versus annuity. For the option shown of a single participant, the single life annuity is roughly equivalent to a 7.5% withdrawal rate on a $425,000 portfolio, while a 20-year certain annuity equates to about a 6.7% withdrawal rate. So if we were to compare that steady monthly payment to investing and drawing down on our own, how would we fare? Now I'm going to show some research published by the Financial Planning Association, building on what's commonly known as the Trinity study. And as an important disclaimer, this is based on historical data and not a guarantee of future results. So if we look at the data published, which evaluates market history from 1929 through 2009, a 7% withdrawal rate, not adjusted for inflation, lasted 30 years 91% of the time using a 75 to 25% stock to bond portfolio, while an 8% withdrawal rate succeeded 69% of the time. What's especially interesting here is the median ending value. At a 7% withdrawal rate, not adjusted for inflation, portfolios ended at 3.58 times the starting value on a median basis, while at an 8% withdrawal rate, that number is 2.26. Now, it is important to note that these figures are not inflation adjusted, which matters because pension payments are fixed. And again, it's very important to note that these figures will not occur in every market environment. This is just the median value. So the takeaway isn't that one option is better, it's that certainty and flexibility come with different trade-offs. And if you'd like to explore this further, you can check out my retirement number video here. I'll also post a link to the data source in the video description. One cost that's underestimated in retirement is healthcare, especially if you retire before Medicare kicks in at age 65. Coverage between ages 60 and 65 can be significantly more expensive than many people plan for. Now, Merck does offer bridge medical coverage for certain employees who meet eligibility requirements, which is why retirement planning should always be coordinated with your benefits team. Another major differentiator between average and strong retirement plans is how money is withdrawn, not just how much money is saved. So this might include which accounts are drawn from first, whether Roth conversions make sense, coordinating withdrawals with Social Security timing, and designing a portfolio that balances growth, income, and taxes. Done well, this doesn't just reduce taxes, it can materially extend how long your money lasts. To tie this all together, I'm going to walk through a hypothetical case study. I want to emphasize that these are not real people and this is for illustrative purposes only. So the couple here is John and Jane. Jane plans to retire in 3 years, and they want clarity around how pension elections would impact their plan, spending and sustainability moving forward, whether Roth conversions make sense, and how resilient their plan is under stress. We'll walk through this in eMoney to see how these decisions play out over time.
So to get into the background here for John and Jane, Jane is 57, planning to retire in 3 years at age 60. Her husband John is 55 and he's already retired. They also have 2 adult children. So as far as financial priorities and goals, the main thing for them here is really just to make sure that they're covering living expenses comfortably throughout retirement. So as we go ahead and take a look at their net worth to see what their picture looks like, their net worth is $2.25 million. This does include the primary residence. However, it does not include that lump sum, which is going to be just over $1 million available in year 2029. So they do have assets spread across traditional retirement accounts, Roth accounts, and then they also have a taxable brokerage account. It's good to have assets spread across these 3 different tax types for maximum flexibility throughout retirement. I will note that most of their assets are in traditional IRAs, and we also have this rollover IRA set up for Jane. So this would be used for that Merck 401k. And should she elect the lump sum in retirement, we do have this account set up for her. As far as income is concerned, we do have Jane's salary and bonus for the next few years. We also have their Social Security projections at full retirement age of 67. People have different attitudes around Social Security, so we can forecast how filing either earlier or later may impact their plan as well. As far as expenses and taxes, the most common way people would look at this would be to look at their current income, adjust out their savings rate, and adjust for taxes in retirement to get a picture for what income they need to replace. Now, it is worth itemizing certain expenses. So we can see the mortgage. Obviously, this is a liability that may drop off at some point throughout retirement. Healthcare expenses are also important to budget for, especially if we're retiring prior to Medicare age. It's also worth noting that Medicare supplemental plans and IRMA calculations are something that is worth factoring in. We do also have a travel fund kicking in for them the year that they retire of $20,000 per year. It's important to budget in these fun things that we get to do to make sure we're maximizing our experiences throughout life. As far as savings and contributions, Jane is still contributing to that 401k plan for the next few years, and we do not have asset allocation or insurance information in here, but these are things that are important to account for within a financial plan as well. So let's go ahead and get into the projections to see how things look for them. So we're going to show their lifetime portfolio value throughout retirement, assuming that they take that lump sum option. So that is the first option. So here we can see if they were to take that lump sum, we can see a nice boost to their net worth in year 1 in retirement. A few notes on the growth rate assumptions here. So the system default is a 6.6% rate of return pre-retirement, and then a 4.2% rate of return after retirement. So the reason we see a little bit of dip here is that we're assuming that they're spending more money early in retirement on travel, and then a little bit less money as they go throughout their retirement. Now, the reason we use that 4.2% rate of return as a system default is that it's a relatively conservative rate of return. I should note that this also does not account for market volatility. So we can run a Monte Carlo analysis and some different things to show how market volatility may impact things as well, but that's the subject for a little bit longer of a video. We can also account for their earliest retirement age and maximum retirement spending. So what the system is doing here is modeling out a probability of success of 80%. So what that means is that what's the maximum amount you can spend that still is going to leave an 80% chance that we still have some portfolio assets left at the end of our life. Now, it's very much worth doing this because if there's a big difference between that number and what we're actually spending, there's a little bit of an opportunity to spend money there with more intention, whether that means helping your kids out with wedding expenses or contributing to a grandkid's 529, taking an extra vacation, some things like that. It's kind of worth seeing, hey, how much money could we actually be spending and where is the difference there? So let's go ahead and jump into the main alternate scenario here of instead of doing that lump sum, we're going to take that 100% survivorship annuity. And I don't think it's necessarily a surprise to anyone to see a graph that looks like this, where the blue line is going to be a lot lower early on in retirement, but then we're kind of seeing this break even happen somewhere in our late 80s, early 90s. So the situations, as we talked about before, in which the lump sum performs better than the annuity is going to be if the markets perform well. So this graph right here is showing a 4.2% rate of return. But if the markets perform better, that lump sum option is going to look a little bit better. If the markets perform worse, that lump sum option obviously is not going to look as good as that annuity option. Another thing worth noting, obviously, is going to be our longevity. So the longer we live and the worse the markets perform, the more that annuity is going to look favorable. Whereas if our life expectancy is a little bit shorter or if the markets perform better, that lump sum option is going to look better. And I should note that even if we live longer, if the market conditions are more favorable, it can be difficult for that annuity option to catch up. But this is where factoring in our own life circumstances and our own attitudes towards risk and investing can be important as we navigate this decision. So the next thing I want to talk about throughout retirement is going to be their tax situation and whether or not Roth conversions make sense for them. So we're going to look at their tax bracket report here. So like I said, most of their assets are in traditional retirement accounts. So flipping assets into Roth can be something worth evaluating. So as we look at the blue lines here, this light blue line is showing their tax burden or their taxable income throughout the rest of their lives. So we can see that while Jane is still working, they are paying a fair amount in tax. However, whenever she retires, and we assume that we're taking a little bit more money out of that taxable brokerage account, or maybe not spending as much money, they do not have as much taxable income. So there may be an opportunity to do some Roth conversions there. And then we can see as they go later and later into retirement, because of RMDs and because of that, most of their assets are being drawn down on their IRAs, which is taxable income. We can see that tax burden going up. So if we do elect to flip on that Roth conversion, we can see how this forecasts for their situation. And I should note it's very favorable for their situation, but it is not favorable in all situations. So it is worth having a customized plan built to see how this looks for you. But in their situation, their cumulative taxes throughout their life do decrease and their portfolio assets do increase. So for them, this can kind of be a no-brainer, and we can see that we're spilling over into those higher tax brackets less throughout their life because we are converting assets from a taxable traditional account into that tax-free Roth IRA. So obviously that can be a win there. So the next thing that we really want to forecast in here is going to be stress testing. So what if things don't work quite as well as we had hoped for, or things go a little bit differently throughout retirement? So what we're showing here is that the default growth rate is a 2.5% rate of return. So our portfolio is only matching inflation. We're assuming that we're going to live a little bit longer, and we're assuming our living expenses are a little bit higher. So as we go to that lifetime portfolio value chart, we can see that, right, there's a little bit more risk of running out of money as we go later and later on here. And we can see that we're really kind of losing value relative to where we were before. So again, it can be worth stress testing. Hey, what if things don't quite work out the way that we hope for? What if I live to be 100, which is great, but are my portfolio assets gonna last? And really stress testing that plan.
If you're approaching retirement and want a second set of eyes on your pension decision or retirement income plan, you can schedule an introductory call using the link in the video description. There's no obligation, just a chance to walk through your situation and see whether working together makes sense. And if you're watching this as part of your own research, I'd always encourage you to coordinate directly with Merck Benefits team before making any election. Thank you for watching, and I'll see you in the next one.